This is the business of Africa. If it's about Africa, then it's our business, bringing big and small business issues right to your doorstep. So the case for Africa driving its own development has long been made, with proponents arguing domestic financial resources must be mobilized and deployed effectively to achieve this. New research by the African Finance Corporation is adding meat to the arguments. The 2026 State of Infrastructure report has found that Africa's capital base has expanded just north of $4 trillion, driven largely by pension funds, development banks, sovereign institutions, and reserves, among others. Mickale Vogel is Associate Vice President of the research team at AFC. He joins us to look at some of the salient findings. Thank you very much, Mickale, for joining us on the Business of Africa podcast. Maybe let's start with an introduction of the AFC to our listeners. What work do you do and what are you solving for?
Good morning, and thanks for having us. So the Africa Finance Corporation is a multilateral financial institution that was established in 2007. So it will celebrate 20 years next year. And our mandate focuses on the development of the continent, and we achieve that via several avenues. The first one is by providing pragmatic financing and technical solutions to address the infrastructure gap that we face. The second one is by supporting projects with broad-based socioeconomic developmental impact that accelerate economic growth and industrialization. And the third one, and equally important, is our work on de-risking projects and building partnerships that increase private sector participation across infrastructure on the continent. So when you talk about AFC in 2026, we have assets of about $19 billion. We have 48 African countries as sovereign members, and we've supported sectors that are critical to the development of the continent, from power to transport and logistics, heavy industry, metals and mining, and digital infrastructure. Now, just to give you a few examples of some of the renowned platforms or projects that we've supported that you might have heard of, they include Infinity Power, which is Africa's largest renewable energy provider, Arise IIP, the network of special economic and industrial zones, and the Kamoa-Kakula copper operations in the DRC, which now house Africa's largest copper smelter.
Thank you very much for that comprehensive introduction. It is often said that there is a symbiotic relationship between infrastructure and economic growth, which ultimately leads to development in a number of areas. Let's take a look at the State of Africa's Infrastructure Report 2026. How was the research put together?
So when we do research and when we develop, investment propositions on the continent, we essentially combine both primary and secondary research. So on the one side, we draw extensively from official data sets, disclosures and reporting from central banks, regulators, utilities, stock exchanges, infrastructure agencies. And here, a very important point that we want to note, because it's very encouraging, is a trend we've seen on significant improvement in the transparency and data availability across the continent, especially from the public sector. Second, and equally important, is the primary research, because as an investor and operator on the ground, our research is informed by direct engagements with governments, utilities, logistics operators, mining companies, airlines, you name it. So that allows us to produce research that really reflects operational realities, investment constraints, and pragmatic investment opportunities where we think there's the biggest potential for impact. So whenever we publish research or reports, it's not just desktop research. It's really grounded in how infrastructure systems evolve and where we see the biggest opportunities.
Okay. You mentioned that one of the points that you were solving for on the continent is development. And so help us understand Africa's development financing model and how it's been working.
So this is very, very key. First of all, it's very topical given what's happening in the world today, but it's very key to what we've done this year. So for decades, the development financing model of the continent has been heavily centered around external capital. So whether it is concessional financing, development assistance, aid, FDI, and so on. So that model has, of course, helped to finance some important infrastructure and social projects, but it's created a degree of structural dependence on global liquidity and global investment appetite. So just to give you a quick number, just aid represented over $770 billion over the past 10 years, and that's about 44% of all external capital flows into the continent. Now, the problem with that is that the environment globally is changing. So when you combine global shocks, tighter financial conditions, geopolitical fragmentation, you have a recipe that leads to the reduction of the scale and predictability of those external capital that will come into Africa. So just the latest numbers we have for last year, for instance, for aid, shows that it's been decreasing since 2020, and in 2025, it was the largest contraction on record at minus 23%. So our key message is that Africa needs to rebalance its financing model. And that does not mean abandoning external capital because it will remain essential. It means placing a much greater emphasis on mobilizing and intermediating your own savings and capital pools. So just to illustrate the scale of the opportunity or potential that we see, external capital into Africa over the past 10 years represented about $1.7 trillion. But the domestic capital available on the continent is over $4 trillion. So that's more than double that. And so that's why the important point that we make is that because capital increasingly exists on the continent itself, the challenge now that we need to really work on with the public and the private sectors is creating the financial architecture, the investment vehicles, and the infrastructure pipelines that can deploy and attract that capital productively into the real economy.
Okay, let's see how we can do that, and maybe we can break down that more than $4 trillion in Africa's capital base. Let's start with pension and insurance assets that crossed the $1 trillion threshold in 2025. Break that down for us.
So first, I just want to explain to you the way we approach this, right? Because for many, many years, we only had extremely gross estimates of the capital pools that we think are available on the continent because they're inferred with some extremely broad methodologies. So what we do is take a bottom-up approach. So we go and map out capital pools country by country, mostly by relying on regulators and central banks' data. And so this is where we're able to come up with an estimate that is not perfect, but that we believe is the most updated and realistic estimate we have on capital available in Africa. Encouragingly, indeed, what we see is a growth of institutional assets, especially pensions and insurance. And we need to be a bit careful with that because most of it is heavily concentrated in South Africa. So you're talking over 70% for pensions, over 80% for insurance, but it is growing across the continent. And we see markets where we call them, mid-sized, what we call them the emerging allocators, markets with deepening capital pools of institutional money that are increasingly able to channel that into infrastructure. So that would be your Nigeria, Kenya, Tanzania, Namibia, Ghana, that are smaller in size than South Africa, but have enough assets that they can actually do meaningful investments into infrastructure with it.
So we are finding that, we're playing catch up in some countries where this is concerned. To your point about this being heavily concentrated, because then what is the reward, right? What could 5 or 10% of pension assets build?
This is key. So as you know, the African Union has an agenda of 5%. We try to illustrate what you do with 5 to 10% just by using pension money. So if you were to go and use, 10% of your African pension capital into infrastructure, you can truly finance some of the most transformative projects that the continent has been putting on the table for many, many years. So, the Grain Gam, for instance, which could power, the development of the DRC, but also help address the energy deficit in most of Southern Africa. You could finance critical transmission lines that would interconnect large pools of stranded power, like in Angola, with key consuming regions like the Copper Belt. You can finance, oil refineries, steel plants, data centers that would really have a significant impact on the trade balance of the continent and on building self-sufficiency in key basic products like steel, fuel, and fertilizers.
How do you mobilize these pension and insurance assets with the levels of unemployment in many parts of the continent, right? And so you've got this burgeoning youth population, but they're not able to contribute towards pension and insurance assets. And so what is the thinking around that?
So that's a several billion-dollar question. But the key thing is to understand that this will be the defining economic question for Africa over the next 2 to 3 decades, because your demographics alone are not a development strategy. So the key question is whether you can build the economic structures that can productively absorb that labor force. And what is important to always remember, that's often overlooked, is that the demographic transition that Africa is currently experiencing is also a financing opportunity. So a growing working age population means a growing base of workers, contributors, savers, and consumers. And so historically, every major economic transformation in the world, whether it is in Asia more recently or elsewhere, was accompanied by the expansion and formalization of domestic savings through pensions, insurance systems, banking sectors, capital markets, and so on. The only difference is that decades ago, you were formalizing your system through usually the post or the postal network or through your kind of brick and mortar banking system. Fast forward to 2026, you've had a lot of digitization, you've had a lot of digital technologies, people have adopted mobile banking, mobile money. And now it's thinking about how do you use those tools, not just to enable people to make payments, but to enable people to efficiently save money and then have the official system capture that money and invest it productively. And that mostly goes through digital public infrastructure. And so this is why you are seeing increasingly, e-services being rolled out by governments, increased digital identity. And those are about formalizing the system and being able to, capture more of that informal economy that is so sizable on the continent. The last thing I want to close on is that's why you need to understand that the demographic dividend and the financing question are actually deeply connected. So the more you formalize employment, expand the productive industries and integrate markets, the more you can simultaneously create prosperity, deepen savings, and then finance your own development from within.
I'd like for us to take a look in particular at the informal economy just a little bit later on. But in terms of sovereign wealth funds, what is the case for sovereign wealth funds, one, and are we seeing them expand in number and strategic relevance?
Yes. So there's a key trend here in that most of the initial sovereign wealth funds set up on the continent were what you would call stabilization funds, which means they basically save the excess money from the system or from the balance of payments and then keep that for rainy days or in terms of economic recessions when commodity prices are low and so on. Increasingly, the sovereign wealth funds being set up on the continent also have a development mandate, which means they're not just here to save money for rainy days, but they're here to save money and reinvest it into strategic sectors of the economy. So you're seeing this in countries like Senegal and Gabon, but it's really becoming much more of a trend. And this is why you've seen a lot of new announcements of new sovereign wealth funds being set up over the past, 2 years or so in Zambia, Kenya, and the DRC. And so now it's about how can they, work together, but also build the capacity so they become local partners that can attract international capital.
What of public development banks? What did the research find?
So here, what we find is, again, the assets are growing. We estimate them at over $275 billion, largely concentrated into regional banks. So, the African Development Bank, Afrexim Bank, AFC, TDB. And so the regional development banking system is thriving, but at the national level, what we see is still a lot of fragmentation, which means your national development banks at the country level are still, have still balance sheets that are either too small or too weak to be able to play a proper development role. And so there's probably a lot more work to be done on creating better environment to enable these national banks to access the capital markets and to raise money more efficiently and cheaply.
So whether it's pensions or sovereign wealth funds or central bank reserves or public development banks, we're seeing them expanding, right? But despite the expansion, you note in the report that asset allocation patterns remain a binding constraint. How so and why?
There is two elements here. There is a trust element, or in what we call the intermediation challenge, and then there is a policy element. So I'll start with the policy and regulatory frameworks, just because this is where we've seen some type of change. What we see is by African regulators to enable your pensions and insurance to invest in the real economy, in the private sector, in infrastructure. So if you look on the policy front at the regulatory reforms that have happened in Africa, we can essentially see two major trends. The first one is that in smaller and more open economies like Namibia or Botswana, the efforts have been focused on retaining capital domestically and reattracting some of the assets that were invested abroad. In larger and more diversified markets like South Africa, Nigeria, Ghana, the emphasis has been more about shifting towards expanding the list of where pension and insurance can invest in, enabling them to invest in infrastructure, private equity, or other alternative assets. So this is the trend that, for instance, in South Africa in 2022, led to the amendment of Regulation 28 of the Pension Funds Act that allowed, up to 45% of assets to be invested in infrastructure-related investments. So that's the first thing, and it's a good thing. Now, the problem is what we see is, despite that increased regulatory flexibility, capital still remains trapped into short-term instruments. So what we mean by that is, if you look at where the money currently goes, a large share of it is concentrated in what we call government securities. So your treasury bills, domestic bills that have maturity under 1 year. And that essentially means that African governments borrow at high nominal rates, sometimes above 12%. And when inflation is high, and it has been high in many countries since 2020, your actual returns are sometimes negative. So the concentration in government securities means that you have an inefficient capital allocation whereby you create a high cost of capital for governments and you erode the returns for investors and African savers. So the bottom line is that even though the regulations would allow you to do more, there is a missing layer of trust and capacity. And that's what we mean by intermediation. You need to have better African institutions that can rely on credit enhancement mechanisms, guarantee platforms, hedging solutions to have that layer of trust where your pensions and your insurance feel comfortable to allocate more money into the real economy instead of, making a safe choice of going for government securities. And so that's the key first call to action we have, is on creating that intermediation. The second one, and very important, is on allowing cross-border investments. Because what we see is, even though domestic capital pools are growing, they are still, fragmented along national lines, and they're very limited into where they can invest outside of their own national borders. So you have those tight restrictions that limit scale. What we see is, in regions like East Africa, for instance, your pension funds are allowed to invest within the East African community. And that's a good start. We think more needs to be done, but that's already a very good start to say, a pension fund in Kenya should be able to invest in the development of Uganda, Tanzania, or Rwanda, because ultimately it benefits the whole region, so it benefits Kenya. And so this is a key call to action we have, is to really have regulators working on more flexibility to allow cross-border investments across the continent.
Okay. Please bear with me because you touched on 2 points that are incredibly important for the success of any of the work that you do, that I do, in terms of, because I'm incredibly passionate about development as well for the continent. And so it's been how long that we speak about fragmentation, it's been how long that we speak about trust and capacity, so this intermediation. So where fragmentation is concerned, I hear you saying that maybe we need to start at a regional level in terms of solving the bigger continental issue, right, of driving industrialization through infrastructure. So one, what do we need to do more practically to close the gap in terms of fragmentation? And I hear you talk about policy as well. And when it comes to trust and capacity between the public sector and the private sector, what do we need to do? Is that policy as well? And I ask because it's been so many years. Much of this is not new, right? So how do we actually bring it about to fruition, more so when we speak about this youth dividend, when we speak about a continent that is also highly informal? And so what do we do? Because for people to put their money into these institutions, they also need to know that they can trust that their monies will go or will be well managed. One, for people who are informal to be formalized. And so I know it's long-winded and it's a lot, but these are questions that go through the mind when you engage with these reports and with the work, and we try to close the development gap that is on the continent. How practically, what do I say to my niece? What do I say to the young man on the street corner who's got a table with bubble gum and Gips, it's local popcorn here in South Africa? What do I say?
So on the fragmentation, the bottom line is you cannot wait for everyone to be ready. And so, we must keep in mind there are 44 countries on the continent, and you need to start with what we call the coalition of the willing. And so this is why we identify specific markets where savings are growing, regulations are becoming more flexible, and there is potential for action. East Africa is a great example, but it's really bringing that awareness that pulling savings at the regional scales allow you to do much bigger investments that have a much bigger impact. For instance, let me switch to an example on the West African region. If you speak about developing the Lagos-Abidjan corridor with a $15 billion highway that is going to have private concessions. Private concessions means tolls. Tolls are an extremely stable stream of revenue. So you could potentially have here a very attractive option for pensions funds to invest in a very critical infrastructure project, but that would require doing it at the regional level because you're talking about a regional trade corridor. So whether you do it within a regional economic community by tapping into the existing policy framework, or whether regulators come together to enable cross-border investments into specific regional projects, there is so many ways you can go about it, but it will not happen across every country on the continent. For instance, what we understand from the South African reform in 2002 is that pension funds can invest up to 45% in infrastructure-related investments, but it didn't specify only within South Africa. So that's a good start to be able to think a bit more strategically and at the regional level. So that's on the fragmentation side. On the trust side, what is very encouraging is you've seen models that have been established, built, and have proven success. So in Nigeria, for instance, there is a credit enhancement platform that was put together, I think, back in 2017, if I'm not mistaken, with the support of the Africa Finance Corporation, the local sovereign wealth funds, the NSIA, which shows, a regional development bank being able to work with the national sovereign wealth funds on putting together a platform that issues guarantees for pension funds to invest in infrastructure. And this has worked significantly. So in Nigeria, over the past almost 10 years now, your capital allocation into infrastructure directly have grown from just about $6 million to over $200 million today. So that is significant change in less than 10 years. And we're seeing this being replicated into other countries. So in Kenya, for instance, with the launch of the Dhamana Guarantee Company, which is going to essentially replicate a similar model. And that can also be done in countries like, Angola, Ghana, South Africa. So those trust doesn't come out of thin air. You need to have your African institutions committing to action and actually delivering on their promises, which is what we've done in Nigeria, which is what we're doing in Kenya. And increasingly, we're seeing a lot of appetite from other markets to replicate something similar. But, and that's the key lesson, it will not come from external partners alone. It needs to be anchored in African agency and African institutions.
Thank you so much, Mickale, for your contribution on this episode. Mickale Vogel is Associate Vice President of the Research Team at the African Finance Corporation. Thank you very much for tuning into the Business of Africa podcast, where we bring big and small business issues right to your doorstep. You'll hear from us again in the next fortnight, God willing. Bahaichu, Bula.